Another day of MBS being down on the open. Today we're down 11 basis points early. Both of this morning's reports were obviously much stronger than expected, but it's retail sales that carries the biggest stick. That stick is currently pointed directly at bond traders in the direction of the sell button. After the flat overnight session, 10-year yields were up a quick 3.5 basis points at 3.788 in the morning. Retail sales came in at up 3% when it was supposed to be on the forecast at negative 1.9. It was negative 1.1 previously. So people just keep spending money, which is going to keep increasing inflation. The New York Fed Manufacturing Index came in at minus 5.8 on a negative 18 forecast. It was negative 32.9 previously. Yet more good news, which hurts the bond market. U.S. retail sales rose in January by the most in nearly 2 years, signaling a robust consumer demand that could bolster the Federal Reserve's resolve to keep raising interest rates. Whilst when stripping out autos and gas, it's still up 2.4% after a negative November and December. This is especially strong. Mortgage rates are rising now in anticipation of future Fed action. Markets are pricing in 3 more Fed rate hikes, with a Fed rate above 5.25 heading into 2024, when just a couple of weeks ago at their recent lowest, and the markets was pricing in 1 more hike, and actually a lot of people were anticipating a cut in 2023. Home builder confidence improved in February. Oh, Jesus, for the love of God, thank God these people are finally looking up a little bit. With the largest monthly increase in builder sentiment since June of 2013, the HMI indicates that the incremental gains in housing affordability have the ability to price in buyers to the market. Man, that is it hasn't changed that much, and it swings sentiment that much. I hate that measure. I think I only report on it so I can bitch about it at this point. Cass Freight Index measures shipments and the cost of shipping goods. If shipment component was down 3.2%. If the slowdown continues, it's recessionary. The 20-year auction this afternoon gave an indication of where we are really. The 20-year auction was met with average demand. The cover was 2.54, which was below the 1-year average of 2.59. Direct and indirect bidders took 93.3% of the bids versus an 88.3% average. We also got industrial production, which was flat in January, according to the Federal Reserve. Manufacturing output rose 1%. Capacity utilization fell 78.3%. Ooh, that's not very efficient. At the end of the day, we were down 5 basis points, ending us over at 100.19. At 100.19, that's putting us right above this blue line, which is the S1 Fibonacci at 100.094. All these ranges are kind of converging on each other, but we're getting a lot of volatility because people are trying to predict the market and all the data coming out